Hi, I'm Dryden Pence. It's 3:30 p.m. on Wednesday, December the 29th, 2021. Happy New Year. Merry Christmas, happy holidays, and may the joy of the season be with everyone. Now let's take a look at what's happened in 2021. Also, we'll look at the virus currently, inflation, the Fed, the economy, what's ahead for 2022, and then as always, kind of what's the big so what. So thank you for joining us, and I hope you find this informative. First of all, let's take a good hard look at what's going on right now in COVID. As you can see, we're into the next wave. There'll be Omicron. Then there'll be like Sigma and Phi and Rho. And yet everyone is going to know the entire Greek alphabet before this is over with, because it's going to come wave after wave after wave. Nothing has stopped it so far, and we probably can look forward to further waves after this Omicron or whatever it is. Now, you can also see circumstances in Europe, right? Where you look at the virus and what's happened in Europe, they're having higher instances than we are, and this has to do with population density. So when you think of the global economy, you have to pay attention not just to the U.S., but what's going on outside. Now, the good news, if there is any here about the virus, is that the most current variant really is not creating a massive uptick in mortality. Now, you are still seeing an increase in hospitalizations and by age. But the important thing here is the current variants of the virus is not having a dramatic increase in mortality. Now, moving forward, what happened in 2021? What's very important to recognize is the great dynamic that occurred. We had the virus. You can take a look here. It kind of settled down a little bit throughout part of the year, and then we had another wave, and then it kind of settled down. But when you look at that, the big thing besides the virus that came on is we had a tremendous amount of government spending. A tremendous amount of government spending. We put $5.4 trillion. That's more money than we spent in all of World War II. In 1 year, we put $5.4 trillion into the economy. And that really kind of both stabilized everything that was going on, but then drove everything forward. And it's actually created some inflationary pressures and some economic pressures. The good news is that it stabilized the economy and kept everything moving forward. The other news is that now we have, because this was government spending, now we have some inflationary pressures that we have to deal with. Now, what did all this do for the market for 2021? As those of you who have been following us for a long time know, every year we publish what we call the range fan. That's the calculations we do statistically and based on earnings estimates of what we think the market's going to do. And we track this throughout the entire year. So you can see when we published the probabilities for 2021, this was the range fan that we used, and you can see that the results have come well within the expectations that we had. Actually kind of to the upper level of those expectations, but well within the expectations that we had. And again, this also kind of takes a look, when the market gets toppy to the top of the fan, it kind of falls back down. This is this volatility thing that we always see. Now, a little bit later in the presentation, I'll show you what we have going on for 2022, so stay tuned for that. But here's the important thing to recognize of what happened. I've listed 2020, 2021, and then since 2019 for the sectors of the S&P 500. This recovery, this event that we had of COVID and the recovery thereafter has really worked its way through a variety of sectors. You can see in 2020, the recovery was really focused on the infotech sector and consumer discretionary. And then you can see as we moved into 2021, a lot of those sectors that were really hurt in 2020 finally recovered. So you have this moment where the stock market recovered in 2020 with a couple of sectors, leaving many behind. And then in 2021, the rest of those sectors have caught up. And so if you take a look at the market since over the last 2 years, and we span our time horizon about this, what's happened throughout all of this COVID and response thereof, you can see where the market is as we look back since 2019. That's very important because although the results have been very, very good, over this period of time, you can see some sectors like utilities and energy still lag dramatically. And the important thing is what's going on in the future? Where do we go from here as we've looked at these various sectors of the economy and how we're moving forward. The other thing that I also want to point out is, like, where's the money going, right? And so a lot of money has now going into overseas markets. So if you think about what's going on outside the United States, their recovery in many ways from an economic standpoint has been slower than ours. I mentioned, and I showed you the data on Europe with the COVID virus and stuff. And now you can see money and inflows to investment is going overseas a bit, because right now we bid up the U.S. markets quite a bit. Now the money is looking for a place to go. Well, now you can see here we've put more outflows or more money into foreign markets in the last year or so than in any time in the past 19 years. So you're seeing money going overseas as it looks for other places for recovery, because really the U.S. economy has fundamentally moved from recovering to somewhat of recovered. Now, what does that do for us for 2022? If I was to characterize the 2022 market, what we think about the future, I would call it a consolidation market. What I mean by that is, we said 2020 had parts of the market really go up and recover quite well. And then in 2021, we had kind of the rest of the market catch up to it, and that's what's affected this S&P 500 movement this last year. So everything now is pretty much moved to a recovery level, right? And so now earnings, because those are the expectations that they're recovering, now earnings have got to catch up. So in the end, it's all about earnings. So we're seeing this moment that we think for 2022, this is the moment where profits and earnings are going to actually begin to catch up and begin to really justify some of these valuations that we have today. So for 2022, it's really going to be about show me the money. People are really going to start looking at earnings and focusing on that to determine prices. Now, there's some good news here, because when you go to show me the money and you look at that, you can see in the last 2 quarters, U.S. businesses have posted the widest profit margins that they've had since 1950. So we've got to be very careful here and pay very close attention. Profit margins are expanding. Companies are making more money coming out of this coronavirus recession, and with all of this stimulus, they're able to push through some price increases with inflation, and we're seeing margin expansion. So you've got widest profit margins since the 1950s. This is a big deal. It's very important, right? We saw the U.S. economy after World War II take off dramatically. Okay, and it stayed that way for a long time. Now you can see this is still happening after the coronavirus war, if you want to talk about it. You're beginning to see profit margins of U.S. companies go through. And indeed, this is showing up in all sorts of ways, right? This is buybacks hit records. We've seen record number of share buybacks for companies where basically they feel like the best use of their money is to buy back their own shares. Or you can see companies now have run in over $12 trillion in financial markets. What I mean is they're able to go out to financial markets and get all sorts of capital that can be invested in doing things better in the future, increasing those profit margins in the future. So that's an important thing for investors to consider. Now let's go and look at the buyout binge. It's the same phenomenon showing out in buyouts, right? Either a company's going to buy their own stock or someone else is going to buy the company. And so we're beginning to see this occur, and we can see some more momentum around that during 2022. But if we look at the earnings per share forecast, these are awfully good numbers. Now, if you looked at what went on with this massive increase in 2020, right? You see the 2020 estimates, when it's all over with, 2020, 2021, you can see this massive recovery that we had. As we get into 2022, you can see the estimates growing a little less because we're like coming off of that pandemic contraction. So we think that estimations for 2022, 2023 are going to be pretty good, but they're going to be more of a normalized earnings per share forecast, but they are still very good numbers. Now, those of you, again, going back to our range fan, this is all the math around it, where we take a look at earnings per share and the probabilities and the PE ratios that we think that will come. So we've constructed the range fan for 2022. And these are our estimations of what we think the S&P 500 will do. We'll probably have some moments where it drops and we have a contraction in the market, but then also we can take a look at recoveries. And we think that this year you're probably looking at a more of like a high single digit, low double digit market at the end. Obviously things can change, but I think the important thing to recognize, if we just take a look at the earnings growth that we see and the profit margin expansion that we see, these are all fairly positive. But then we also have to discount a little bit by some of the things that are going on, right? This is going to be, this year, is that what I'm talking to the guys about, is that this is really kind of a hand-to-hand combat year. We're going to see some volatility. It's going to be stock by stock, holding by holding, earnings report by earnings report. This is where fundamental research makes a big difference in long-term performance. Now, let's talk about the big things. Let's talk about inflation. This is the thing that we have to pay close attention to. We've talked about this before. We brought this up months ago where we tried to ask that question of, is it transitory? Is it permanent? Our answer was yes. Part of the inflation that we have is due to supply chain constraints. That's the part that's probably transitory. When we talk about permanent or longer term, that has to do with the amount of money that fiscal stimulus has put into the economy, right? And that is now showing up with some inflationary pressures. So let's talk about individual expectations. If we look at consumers, their expectations have gone way up on inflation. The median 1 year ahead expected ratio for consumers is they're thinking like we're going to see 6% inflation this year. But then if you think about 3 years out, they think it's going to level off around 4. Now this is important, right? Most people believe inflation is higher this year, but that it will level off. That's an important thing. But the other thing that's important to know is this is what the consumers believe. However, the policymakers, right, believe something a little different. And you have to pay attention to this because the Federal Reserve thinks that we're probably going to hit 2021, we'll end that with about 5.3%, but then they think 2022 that the transitory piece of this economy comes way off and that we end up with about a 2.6 inflation rate, which is more likely to what they want. Now, the important thing we have to take a look at is all of this is betting on how real is the transitory portion of inflation. Remember, you probably have a real portion of inflation that's probably 2 to 3%. And then everything on top of that is probably due to supply chain constraints. The question is, how soon do these things get resolved? Now, this is kind of the chart that everybody wants to show you. This is an important consideration, folks. This is the chart that will say that, yes, we fixed the problems at all the container ports and the numbers have gone down and container ships at anchor and hold in the West Coast. There's all the supply chain things. We've really made big progress. And they hold press conferences and they say they've done this. And this is the slide they show you. Here's the problem. It's inaccurate because reality is more like this. What they did is they said, we're just going to hold ships off at sea and not let them come in. And therefore, those numbers won't show up and the press won't be showing pictures of all these ships backed up at the ports. And thus the problem goes away. Not true. When you take a look at the ships that are loitering 40 miles offshore, this container problem, this shipping problem is still real and it is growing. And if you don't believe me, there's the satellite picture. You can see all the ships holding offshore, driving around in circles, right? It looks like a backup at John F. Kennedy Airport, right, during rush hour and planes trying to land. The point of the matter is we do not believe that the supply chain issue is going to get resolved quickly in 2022. We think that it's probably throughout the entire year, if not longer. That's an important consideration because that means that this data around transitory inflation is going to stay higher for longer. And so we begin to see here, the ships are still, the average wait time is still 21 days. So now what you're really seeing is to make their numbers look better, they're saying, oh, there's fewer ships waiting for berth, but that's just because they're making them wait 40 miles offshore. So we have to be really careful in assessing this and recognizing that this is still going to be a problem throughout 2022. Supply chain constraints for anything coming from Asia is still in place because we have port problems. They have not resolved that, in our opinion. Now, here's the thing that gets important from an investment thesis standpoint. You want to begin to focus then on companies that have fewer of their imports coming from overseas. So if you look at this, here's the sectors of the economy that we think will have fewer problems due to inflation and due to supply chain disruption. So we begin to think about that as investable thesis. The other fact is we look at the inflation. Now Fed wanted to have inflation. They've got it. They've got it. The government wanted some inflation. They've got it. So remember before we were talking about, yeah, we could stand a 3% inflation rate for 5 years before we ever got back to the Fed's target of 2%. Well, guess what? We're already there. We've got 5% inflation in some cases. That's going to speed that up quite a bit. And that's going to drive the Fed to raise interest rates. That's all pretty much confirmed now. So there's nothing that is unexpected. And we're going to see interest rates move off of the 0 level up to around 1%. Now, I want you to understand, 1% on a federal funds rate is still massively accommodative to an economy. It really, really is. But it's directionally moving up. Interest rates are going higher. That's going to affect things. But the only reason why the Fed raised interest rates, right, is that the economy's doing good. That's a good sign in some sense. The other good sign is if you look at continuing unemployment claims. This is a graphical representation of this. And you can see very clearly in this chart, when they stopped paying the excess benefits to people, folks went back to work, right? Unemployment claims went down, people quit claiming that much, and they started going back to work. This is a graphical representation of that issue. And so we can see, if you look at all employees, more people are working than were several months ago. It's continuing to rise. We're at about 149 million, right? We've got a little ways to go till we get back to an all-time high. But the trend is correct. And not only that, we're already to the moment where real wages and salaries are now higher than they've ever been. So there's more money being made in real wages and salaries than ever before. We've completely recovered from the pandemic in that sense. Now, the thing to watch out for is inflation. Remember, this is a real wage and salary. This is inflation adjusted, right? But we're beginning to see a trend that's a little concerning, and I need to bring it up. And that is that if you adjust for inflation, the disposable personal income is beginning to fall a little bit. So that means that inflation is beginning to take a little bite out of how much cash people have left over every month after they pay their rent or their mortgage and food and things like that. This is something that we're going to begin to watch very, very carefully. But there's always, the point of the matter is there's still much good news here. And the good news is that real personal consumption expenditures are way up. More people are spending more money than they ever have before. And that's driven this robust consumption by the amount of stimulus we put into the economy, by more people working. People saved a lot of money during the recession around COVID, and now they're out spending it. So you've got a lot of stimulus money going into it, and you're seeing a robust consumption. That is all a very good trend. But you have to, again, as I said, be a little careful of this inflation issue. So that begs a question. Oh my gosh, what happens if there's inflation? What happens to the stock market, right? Well, history pretty much tells us that most sectors do reasonably well. In other words, even in an inflationary environment, and we haven't had an inflationary environment for a while, so people may have forgotten this, right? But many sectors in the economy and many stock sectors do very well during an inflation economy. So just because we have inflation is not a reason to be overly fearful about the equity markets. It's just recognizing that some of them do better than others at other times. And so we have to stay aware of this and on top of it. So let me sum this up for you. In 2021, it was very positive. Right? We had a positive market, and that was due to stimulus and recovery. Now we've reached this moment that we have to kind of take the training wheels off a little bit and see how this economy is going to do on its own. We think it's going to do pretty good. Now, the virus is still resurgent. The good news is it's not as deadly or likely to trigger complete shutdown. So in every one of these moments, right, there's a little good news, a little bad news, but the good news is overweighing the bad news at this point. Inflation, we've talked about that. It's transitory for longer. That means we can see these elevated levels of inflation, not just for 1 quarter or 2 quarters, but probably throughout most of this next year. But then we'll begin to see it abate a bit because the supply chain will eventually straighten itself out. But I think that anytime you put this much government spending, right, this much government spending and stimulus into the economy, it's going to show up as inflation. And so we're going to see when we get past the transitory point, it's not going to go back to a 2% inflation level. In our opinion, you're probably looking at something higher, maybe somewhere between 3 and 4. It's a different viewpoint for most people. Now, the Fed. Well, the Fed has made it very clear. They're going to raise interest rates. Well, why does the Fed raise interest rates? The Fed raise interest rates because the economy is strong, right? That's why they do it, right? So, and they've confirmed that. So the economy is generally strong. And we also see that markets are positive. When we go into 2022, we think the economy is generally strong and that markets are positive, but they're consolidating. This is what I mean by earnings kind of coming in behind now to justify some of these lofty valuations that we have. So here's the thing to pay attention in 2022. It's going to be all about earnings. You know, companies that miss earnings expectations are going to get punished. Companies that meet or exceed earnings expectations are going to be rewarded. They'll be less volatile and they'll move forward. So we're going to have be volatile around earnings a lot, but positive. That's our expectation. That we continue to see some sector rotation. You're going to see some sectors. If you remember, I showed you that all the way through from 2019 forward, there were some sectors that hadn't quite caught up yet. So we're going to continue to see some sector rotation, which that gives us some opportunities going forward. And inflation is going to be an issue at the consumer level. We've got to be very careful and pay very close attention to the personal consumption expenditures, what people are spending their money on, because a few movements here and there will be indicative of what's going on in the consumer markets. We have to be very careful and watch out for that. And then primarily we're going to focus on companies that can maintain or expand their profit margin in an inflationary environment. So we're not in the camp that denies inflation. No, it's here. Now the question is, and history shows us, there's a lot of companies that continue to do very well in inflationary environments. Those are the places we're going to be looking for in 2022. Thank you very much. I hope that this has been helpful. We look forward to a positive year next year, and I look forward to many opportunities to see you again on these videos. Thank you, and Happy New Year.